Hey everyone, thanks for joining the video. In today's video, we're going to talk about 15 Canadian dividend stocks that have already increased their dividend in 2023 so far. So 2023 has been a bit of a tough year in lots of sectors, lots of stocks, and lots of economies. So it's a great torture test to see which kinds of companies and which businesses continue to increase their dividend throughout the year. I hope that you'll take away a couple stocks from this video that intrigue you, interest you, position your portfolio for dividend growth going forward, and we're just going to jump right into it. If you like this kind of content, be sure to give this video a big thumbs up. The first stock that we're going to go into today is Dollarama. So Dollarama, the stock's been on an absolute tear. Like all of the pressures in the economy and with the consumer that I was just referring to really has played into Dollarama's hand. You see they're up over 130% in the last 5 years. In the last 1 year here, up 20%, and year to date in 2023, up 20%. You'll see they have a tiny dividend there, and they have a pretty healthy price to earnings ratio of 30 times. So let's look into this company a bit more, look at what they do, how they're growing, and what dividend increase they've done so far this year. So they are obviously a retailer across Canada, a value retailer. They play in items from $1 to $5 pretty much. You can see they've grown their sales in the last 12 months almost 20% here, which is really strong. Their net earnings growth has been 27%. They have gross margins of about 43%, which is an interesting number that we'll get to in a second. When we look at the kinds of businesses and sectors that they operate in very minimal like food and grocery sectors. It's mostly kitchen appliances, health products, beauty products, seasonal products for holidays and stuff like that. And I think that really helps them keep that high gross margin of over 40% because they're not selling fruits and vegetables and things like that have high waste, low margins, and whatnot. The other interesting thing is you can see their brand mix. 2/3 of their business is private label. So they probably have better margins on that side of the business. Only 1/3 national brands that you may be familiar if you go into like a normal grocery store or Walmart or whatnot. So this is a much better mix towards their own businesses that they can get better margins on than buying products from manufacturers, which is interesting. And you can even see within their private label, they do have over 50% of those products imported, probably from China and Asia and other areas that have very cheap cost of goods. One interesting thing about this company is while they have increased their dividend year in and year out, and we'll get to that in a second, they actually buy back a ton of share. So in the last 10 years, they've bought back $6 billion of shares. We can see the company here in total is worth about $27 billion now. So they've bought back over 20% of the current value of the company in the last 10 years, which is pretty decent. Their dividend has grown every year despite having less shares outstanding. So you see 31 million in 2013, up to 50 million in 2018, up to 65 million in last fiscal year, give or take, and looks like they'll be at 72 million this year. So looking at the dividend increase that they just did, they increased their dividend about 30% this year behind the strength they've had on their overall business with that 20% sales growth, 27% EBITDA growth. So you can see the 5-year trend here. They were going at about 5.5 cents a quarter. Now they're all the way up to over 7 cents. So about a 30% increase here. With that being said, in terms of their overall capital allocation, this is still such a small part of their overall net income. It looks like it's about 10-15% of their profits going to shareholders. They really invest much more of their return to investors in share buybacks, and that just goes to show how much they think the value of the company is going to go up over time. You can see here, maybe it dipped down a bit, but even last year, over $700 million in share buybacks, which is more dividends, more return to shareholders than dividends have been over the last decade. So they're really focused on growing the share price and not so much on the total value of the dividend, but it's nice to see it growing at that fast of a pace. Hopefully for investors who get in now at this small dividend, in 5-10 years, it will be a more attractive yield on cost at least. The second company that has increased their dividend this year is Parkland Corp. So Parkland Corp operates a couple different businesses, up 40% on the year, 3.5% starting yield, about $7 billion market cap. They own lots of gas stations around the country. They also own On the Run and some other miscellaneous brands in the convenience space. Going into their dividend history here, you can see they've been a really strong dividend grower all the way back a few decades. So they have the last 12 years or so passed on here. You can see the dividend's grown modestly every year, just a handful of percent, but it's been consistently growing. So over the last 10 years, it's up about 35%. You can see this year, they actually increased the dividend 5% more, which is great to see. So they're in gasoline retail, gasoline wholesale. They also own lots of the convenience stores attached to gasoline stations. So their biggest competitor in that space would probably be like Alimentation Couche-Tard, who owns Circle K. But they own tons of their own gasoline retail brands as well. So a bit of an interesting space. Trading at actually a pretty healthy price to earnings ratio, over 20 times trailing when we look at the run the stocks have of over 40%. But nonetheless, a really strong dividend grower over time. The third dividend growing stock this year in the Canadian market has been Sleep Country. So Sleep Country in the last year, down about 2%, so pretty much flat. Hasn't had a great run over the last 5 years, down almost 20%. Most of that's probably been wiped out from the dividend yield in terms of total shareholder return probably being flat. But this one's really traded down in multiple, only trading at an 8 times trailing earnings on this one. Looking into their business a bit more, if you didn't know, Sleep Country actually owns a handful of other smaller brands as well, as these brands have kind of come up, disrupted the space. They've ended up just acquiring them. Endy, which is kind of like a mattress in a box. Hush, which we'll look at in a second. Silk and Snow, I didn't even know what that company was until today. And then Casper, they bought the Canadian operation of Casper as well. So going over some of their smaller businesses here, this is Silk and Snow. Looks like just like a more premium linens and mattress and pillow company that they swallowed up. Hush was actually a business I was familiar with. I had some Hush products, but they're just weighted blankets, heated blankets, things like that. Very expensive. You can see this is $250 for a blanket for the end of your bed, $129 for a duvet. So more premium adjacency and accessory business that they probably like owning end to end as they sell these in their retail locations to boost the margin profile of their business. But when we look at Sleep Country, so you can kind of see they recently announced the acquisition of Casper Canada and Silk and Snow as they continue to grow their presence and try to vertically integrate what they're selling in their stores. But they also announced a nice 10% dividend increase with it. So looking at the overall stock here, trading at 4.3%. So pretty good starting yield already, and then you just got a 10% raise, despite the stock not doing overly well. My opinion when this kind of stuff happens typically is when a stock already has like a 4% dividend, which is a decently healthy return to shareholders, and they're trading at a price to earnings under 10, assuming they believe in the future of the company, I feel like lots of investors would probably be better off if they started buying back more shares instead of returning more capital out to shareholders. So that's personal opinion. An investor could always take that dividend, buy more shares themselves with it instead of the company buying more shares on their behalf. But that always kind of is a kind of pull and take when I'm looking at companies increase their dividend with already good dividends, but a falling stock price and a falling price to earnings multiple, because they can also return capital to shareholders in that way. The fourth Canadian dividend paying stock that recently increased their dividend is TD Bank. So all of the banks have had a bit of a tough year here. TD down 8% on the year, 5% in the last 12 months. And this is just a really strong dividend growing stock. You can see here over the last 30 years or so, they've compounded their dividend like 1,500% or something like that, 20 cents a share to $3.84. No matter what's going on in the economy, they always increase it every single year. They have a great model in place of creating new free cash flows, having reasonable return on equity, return on invested capital above of their cost of capital, which is creating this excess free cash flow per share. You can see they've grown at over 10% a year. That's a phenomenal rate of growth for a 30-year period, especially when the starting dividend is almost 5%. If you compound growth at 10% a year over the next 10, 20, 30 years, you're going to be yielding a ridiculous amount by the end of your investment journey. And all of this is just with a dividend payout of 40 to 50%. So with really good and consistent dividend growth stocks, I feel like that's one of the key things. They can't pay out 70, 80, 90% of their earnings because they don't have enough capital and profits left in the company to invest in future projects, growth initiatives to grow that dividend year in and year out. So I really like this 40 to 50% payout mandate that they have in place. It's worked really well for them. They've been able to take that excess capital that they've generated from their business, buy new companies, buy back shares, invest in new projects. And through those investments, they've been able to increase it again next year and the year after and the year after that from more and more cash flows coming in. So this is a stock that I own a lot of. It's one of my biggest positions. And while it's a bank, so it's a bit boring perhaps, their track record's phenomenal. And even in tough times, they continue to increase the dividend. So I think my yield on cost will continue to go up on this one. On to the fifth stock here, Stella Jones. Stella Jones here, $4 billion company. They have a bit of a smaller yield, 1.3%. Year to date, this one's crushed it, up almost 40%. Some of you may be thinking, what does Stella Jones do? Stella Jones is a really unique company, let's call it. They operate in a lot of interesting spaces. Some of their businesses here, railway ties. You may not even know what that is, but I think it's just these kind of pickets, for lack of a better term, that get used in transporting goods on the railway. You can see here just on these random types of businesses that are relatively defensive in nature, the growth rates are pretty good. You see going from 650-ish million to 750-ish million over a 5-year span, really stable for the most part, a bit of a dip in 21, but no crash or anything like that. And if we look at other businesses that they operate in utility poles, and going forward, a lot of other businesses like that. So you can see here some of their businesses and facilities. They operate a lot in the US. So this is not necessarily only a Canadian company. They're actually primarily in the US if you look at their largest facilities there. And then they continue to innovate, try to increase volumes, pricing, etc., just like a normal business does. But when we look at how they've been able to increase their dividend over time, you can see even since 2020, increased it 20% in 2021, 11% in 2022, and then here in 2023, they increased it another 15% earlier this year. So they've been able to maintain double-digit dividend increases, yet you're starting at a pretty small yield on cost, just yield on cost, just 1.3%. But if you can continue growing that at 10, 20% a year, and they can continue that kind of growth rate, you can start getting a much higher dividend yield on your money in a pretty quick amount of time. So interesting business, not the sexiest business, but one that will probably be around for a while and trading at a reasonable valuation here at about 15 times. And you're not getting a great starting yield, but you're getting some pretty good dividend growth on a stock like this. Going into the next stock, Canadian National Railway, one of the best dividend growing stocks in the market. You can see here long term, the stock price has also gone up a lot, trading just under a $100 billion market cap, trading just under 20 times earning and paying a 2.2% dividend yield. You can see here, they also focus a lot on share buybacks on the right-hand side. You can see they've bought back a ton of the company, $30 billion of share repurchases since 2000. So in the last 23 years, give or take, they've bought back what would be about a third of the company in current value. So that's probably even significantly more of the company if you average it out over the years. So that just goes to show how they're returning value to shareholders through buybacks, but also 27 consecutive years of dividend growth and really strong dividend growth too. They just announced an 8% increase in 2023. They have had a 15% cumulative growth rate on their dividend per share since 1996. So double-digit CAGRs on dividend growth is phenomenal for the long term for these stocks. And one of the benefits of companies that are buying back shares is they can pay out the same amount of profits on an absolute term. And if they have less shares outstanding, they automatically get to raise the dividend year in and year out, even if they don't want to pay out more money. Now, CN Rail tends to do both. They buy back shares to lower the share count, and then they pay back on an absolute basis more and more every year as they grow the business, which does a great job of just compounding how much each individual investor and each individual share is taking home from the company. The next one here is Empire Company. So I've talked about Empire Company a couple times. This is a grocery chain. They own a lot of different banners like Sobeys and whatnot. $9 billion market cap, 2% starting yield, 12 to 13%, or 12 to 13 times price to earnings ratio. They own tons of different businesses here. You can see from left to right, Sobeys, Farm Boy, Longo's, they have a majority interest in. Safeway, IGA, Thrifty Foods, Foodland. So from a discount perspective, Freshco. From a e-com perspective, they own Voila, as well as some liquor banners as well under their master brand names. They also own 40% of Crombie REIT, which provides a lot of income for them. That business owns a lot of retail centers, shopping malls, stuff like that as well. Going into their projections here, they're hoping to increase their EPS over the long term at about 10%, give or take. So really strong growth rate projections for a company currently trading at, a 12, 13 times earnings. Really interesting to see them at that valuation given their ambitions and their forecasts here. In terms of their dividends, you can see they are increasing the dividend every single year here. 115 million back in 2018. Now they pay out almost 185 million in dividends annually, and they also buy back shares. So going back to CN Rail and these companies that really compound shareholder dividend return by not only paying out more in profits every year, but having less shares. Empire meets the bill on that strategy here. And this was just going back to. It looks like I missed out on one of the companies here, but I'll just close on Empire in terms of how well they've been able to, deliver that absolute return through buybacks, but also dividends. You go back here, 2% starting yield, but if they continue to increase their EPS 10% a year through these acquisitions, through synergies, through top-line sales growth and margin expansion, they should be able to continue increasing the dividend in line with that, just because the dividend payout ratio is only about 30% of their total EPS here. So it's definitely still room for still room for them to increase the dividend, assuming earnings per share and total earnings grow as well. The next stock we're going to talk about here is Diversified Royalty Corp. So this business here owns a lot of trademarks. You see here, Mr. Lube's their biggest one, but I'm just going to go down so you can see some of their other businesses here as well. Air Miles, Nurse Next Door, which is like a home nursing business for elderly people. Oxford Learning Centers, like a tutoring business as well. Mr. Mike's, Sudden Real Estate Group. This is a really interesting one as well. It's like a low-cost brokerage. Every real estate agent that works under Sudden and puts transactions through Sudden has to pay like $70 a month to Diversified Royalty Corp, who owns the trademark, and that money comes straight to you. So this is a bit of a play on real estate and the amount of real estate agents out there that want low-cost brokerages, but it's just one part of their very diversified income streams. Stratus is a commercial cleaning company that operates in the US, and Barburrito was actually the latest acquisition that they just made here, and it is a quick service restaurant chain that they just bought. This one represents about 10%, give or take, of the company's overall earnings here. Looking at just their latest announcement, they've actually increased their dividend very modestly a few times here. They pay out about 100% of their royalty income. So you get these little 1, 2, 3, 4% increases as they see their income from royalties tick up. So they announced a 2% dividend income here just last week, or 2% dividend increase last week, and also that acquisition of Barburrito restaurants that we just went through. Looking at a chart of how that looks over a longer period of time, obviously one of the cons of these royalty funds is it's very real time. As soon as income goes down from, or revenue goes down from their trademark partners, they pretty much have to lower the dividend because they don't have cash on hand, they don't have debt, they don't really do that. It's just a flow through into the distribution. So in March of 2020, it went from 2 cents a share down to 1.7 cents per share, dropped it about 15%. But since then, it has been clawing back up all the way back to 2, and recently over 2 with that recent increase. They're probably about 0.0, like 2.1 cents a share per month. And the stock price is only sitting at about $2.50. So we're yielding almost 10% at these levels here. So great cash flow company, even over the last 5 years. The stock's down 15%, which I think, given the performance of lots of their underlying assets, is oversold in my opinion, and I own this stock as well. But even at that, with a 9% dividend yield a year, you still would have done okay over the last 5 years. You would have got 45% of your money back in dividends. So you'd probably be at a total return of 30% over the 5 years. Not terrible at all. Next stock here that continually increases their dividend is EQ Bank. EQ Bank is a phenomenal growth stock in Canada. You can see they've grown their share price over 50% this year, up over 140% in the last 5 years. And this is at a time that all of the big banks are struggling. I can go big bank by big bank and show you that lots of these stocks that they're competing with and pulling customers with are actually down over the last 5 years. You see Bank of Nova Scotia here down 16%. We'll go to BMO Bank next. BMO over the last 5 years is up 6%. TD, which we just looked at, is also up about 8%. So versus lots of their competitors and the companies that they're trying to pull customers from, they're absolutely crushing them over the last 5 years. And they also trade at a lower price to earnings ratio, under 8 times PE, despite their 100% increase that they've experienced. They have a starting yield of 2.1%, but they continually increase that dividend. You can see here, even in this year alone, from 2017, they went from 11.5 cents to 12 cents to 12.5 cents. 2018, they went from 12.5 cents to 13 cents to 13.5 to 14. They're almost doing quarterly dividend increases, and this isn't just like a 1 or 2 year thing. It's like a 5 year thing. It's been a lot of time to get on this train. Then 15 cents to 17.5 cents. Once again, there was 3 dividend increases that year. 2020, during the pandemic, still increased it 17.5 to 18.5 cents. 2021, we went 18.5 cents. Looks like they didn't increase it there. But then in 2022, huge increases, 18.5 cents to 28 cents to 29 cents to 31 cents to 33 cents. They increased their dividend every single quarter last year, and in aggregate almost doubled their dividend. And now 35 cents to 37 cents to 38 cents. So this is a company that's increasing their dividend at a huge rate, almost 3, 4, 5% a quarter, and it's compounding the double-digit dividend increases on a yearly basis over the medium term, not just the short term. So you may be thinking all that dividend growth, but the company's still at 2.1% yield. That's because the company's gone up 150%. So if you bought this company 5 years ago, it was probably yielding like 1% or something. Your yield on cost would be at about 5% today, and that on a really low PE ratio where they can continue to create value with their free cash flow and increase that dividend further through acquisitions, buybacks, investing in new businesses. I know they recently just did a asset management acquisition. Last year, they just entered the Quebec market for the first time, so they're more broadly spread in Canada. So there's lots going on here. It's a great growth story in the Canadian banking space. The next Canadian dividend stock that's been increasing their dividend this year is GFL Environmental. So this is a company similar to Dollarama, super small dividend, but they're really a capital appreciation story, up 80% in the last 5 years, 25% in the last 1 year. And even though they have that small dividend, they are really looking at growing it. So you see here up 10% in the quarterly dividend earlier this year. So even at those dividends under 1%, if you can start compounding at 10%, 20% a year, 5-10 years from now, you may be left with a stock that's up hundreds of percent, and then you also have a couple percent yield on cost that you're getting into your account every year as well. And that's kind of the model some of these faster growing dividend stocks with lower yields are executing against. And I just missed this one right here, which was the last quarterly dividend for EQ Bank from the stock prior, up 6% on the quarter. So, it seems like they're doing that quarter over quarter. It's like 20% dividend growth a year. The next dividend stock here is Northwest Company. Northwest Company continues to increase their dividend as well. Flat on the year, trades at a 14 times PE, 4.5% dividend payout rate right now. And as you look at their business here, they've continued to grow their sales, their profit year in and year out. Their return on equity is phenomenal, over 20% every year. This is a retailer that works more in rural areas. Think up north in the territories and things like that. Hard to reach places. So it's a bit of a logistics nightmare. Lots of other companies like Walmart, Loblaw do not want to play there. Too complicated. So they have a bit of a monopoly on that space. And you can see here they've increased their dividend on an average of 4% a year over the last 5 years. And we can see that they continue to increase it. This year they just increased it again from 38 cents to 39 cents this month. But every year they're increasing it about a penny. They had a bigger one in 2020, about 10% there. But still, this 3 to 4% annual growth really compounds over time. We can even just go back to 2013, and they're at 28 cents a share. Now we're all the way at 39 cents a share. So that's like 30, 40% growth in 10 years. So that really jives up with that kind of 4% a year increase. And on this one, unlike GFL, unlike Dollarama, you're getting that nice little increase, but you're also getting 4.5% today. So a bit of a different style of a stock. You're getting capital today. You're also getting a bit of growth, which is nice as well. Saputo, okay, so this is where that other chart should have been. But Saputo, right now Saputo down 13% on the year. It's collapsed here recently. $12 billion business, so pretty big business, under 20 times PE, 2.7% starting yield. So not a bad starting yield at all for this business. Looking at what this business is, they are one of the top dairy processors in the world. They have a lot of different markets, whether that's retail, whether that's wholesale. We look at where they play in this video here, or in this sheet here. They have a huge business in America, about 50% of their business, about a quarter in Canada, and then international and Europe's the other quarter. So they're all over the place. With that being said, you can see how much more profitable they are in Canada. Even though they have more business in the US, they do more profit in Canada. Not sure if that's because they do more retail in Canada and direct to stores relationships, where maybe in the US they're going through a distributor. I've never owned the company, so I don't know the details. But this company has also been a phenomenal dividend grower, which we'll get at in a minute. Before that, you can see here some of the brands they own. If you know any of these brands, you may be more familiar with the company. Obviously, their namesake brand. But then they have a lot of other brands in like this space, Dairyland, Milk to Go, et cetera, et cetera. You can pause the screen and look at them a bit more if interested. In terms of their dividend here, you can see here they have recently increased their dividend from 18 cents to 18.5 cents. And then you can kind of see over time here, since 2000, they've increased the dividend pretty nicely on an annual basis. So from just about 3-4 cents all the way up to 70-80 cents a share. And you can see it's pretty steady. So similar to Northwest, this is one that you're not getting big dividend increases every year, just 2-4%, keeping up with inflation and whatnot. But you're also getting a decent starting yield, close to 3% on this one here. The next one, I think this is the 13th one we're going to talk about here, is Thomson Reuters. Thomson Reuters is a media company in Canada, up 20% in the last year, killing it over the last 5 years, up about 150%. Smaller dividend yield, about 1.5%, and a bigger company here, one of the bigger ones in Canada, at about $80 billion. Looking at their dividend here, just phenomenal dividend growth over time. You can see this year they increased their dividend from 44 cents to 49 cents, so about a 10% increase here. But that has gone on for year after year after year after year. Looking back at 2013, they were about 32 cents. So they've gone from 32 cents to 50 cents, about 35% or 45% growth in the last 10 years in the dividend. And in recent periods, it's even ticked up faster. Since 2021, the dividend's grown about 21% alone. So some great compounding going on that dividend on Thomson Reuters. Trade's a bit rich for me for the kind of business it is, but it nonetheless has a great track record. Next stock here is Hydro One. Hydro One is one of the biggest electricity producers, or the biggest electricity producer in Ontario, paying a 3.3% dividend yield, up 15% on the year, up 80% in the last 5 years. So lots of these dividend growth stocks you'll see as we go through them. Not only do they pay a dividend and a growing dividend, but these stocks have been outperforming the market in a huge way over the last number of years. These stocks tend to be really well managed, not have a ton of debt, relatively speaking to their industry and the type of business that they're running. So I truly believe that long-term, holding lots of dividend growth stocks is a great formula, not only for a dividend snowball, but also to increase and enhance the capital gains of your portfolio and the absolute value of your investments, because these companies tend to be much more well managed. Instead of looking at crappy opportunities to invest excess capital into that may or may not create value for shareholders, companies tend to be a lot more disciplined because they know they have to pay you out your dividend. They know they're expected to increase the dividend next year. So they need to be kind of conservative and invest in things that they know will deliver high return on invested capital. They can't be overly risky. And I think long-term, that mindset really compounds into the dividend growth, into the absolute profit generation of these companies. So we see that here in Hydro One, up 83% in the last 5 years. In terms of their dividend information here, you can see they continue to increase as well. So 28 cents to 29.5 cents for the most part. But similar story here. I just go down and they just increase it, no problem, every single year, from 21 cents in 2016 all the way up to 30 cents pretty much in 2023. So over 7 years, increase the dividend 50% for a stable company that's also gone up in value over 80%. Great total return for their investors. The last Canadian dividend stock that's increased their dividend in 2023 here is TFI International. This is a shipping company, up 30% on the year. Once again, these companies are doing phenomenal, not only on a dividend from a dividend perspective, but overall up 270% in the last 5 years. That absolutely crushes any index in the last 5 years. And you look at the dividend, 1.2%, whatever, but it's actually like a 4% yield on cost for people who bought this stock in 2017, 2018. So don't sleep on some of these companies that we went through today that have a 1 or 2% starting dividend yield. 5-10 years from now, that may be 5%, 10%, assuming you're investing in companies that continue to grow and compound their earnings. So for those of you who don't know, TFI is a North American business. They operate a lot in the US, and they're a logistics and transportation company. And they work across many different types of businesses. They do couriering, they do packages, they do less than full truckloads, etc. But they're really in that logistical space. And you can just see, not exactly sure what happened here in 2021, but overall, since 2020, with 26 cents a share, that was not that long ago. They're already up at 35 cents a share. And eye-watering 30% dividend increase here in 2023. Phenomenal return to their investors of capital. So this one of those ones that may be a bit more of a dividend growth play versus a starting yield play, but nonetheless needed to have it on the list since they increased the dividend that much this year. So there you have it. There are 15 Canadian dividend growth stocks that have already increased their dividend so far in 2023. I'm sure there's more to come. Who knows? Maybe some of these will increase their dividend further with those companies like EQ Bank and some of these other ones that increase more than one time a year. But wanted to share some of these with you to hopefully get your mind started a bit, looking at how these companies can not only provide dividend income and growing dividend income, but also just solid foundational businesses to build portfolios around. So hope you like this kind of content. If you stuck it out to the end, thank you so much. Please give this video a big thumbs up and also consider subscribing to the channel if you haven't already. It really does help me out with the channel, and I will see you guys in the next one. Thanks.